Let's prepare the different types of financial statements, but before we go to that one, please see the previous episodes of this series. Their links are on the description below. And don't worry, because if, for example, you start at video number 1, at the end of that video, there will be a suggested video that will lead you directly to the next episode. And if you're finished, then let's get started. On the last episode, we completed this worksheet. Now, before we make the financial statements, I would like to add some things related to this. Number 1 is that the preparation of worksheet is optional. Number 2 is if the unadjusted trial balance, adjustments, or the adjusted trial balance columns is not balanced, instead of directly checking every single journal entry that you have made, which is so much hard work, you can do the following first. Get the difference of debits and credits first, and then divide the difference with 9. If the quotient is a whole number, like for example, the difference of debits and credits is 9,000. If we divide it by 9, the quotient is 1,000, and there are no decimals. If that's the case, the error might be a slide or a transposition error. But what are those? Slide is an error with decimal places. For example, you posted an amount of 10,500 instead of 105,000. Or you posted 13,551 instead of 1,355.1. While an example of transposition is when you posted 109,000 instead of 190,000. In these two types of errors, if you try to get the difference between the correct amounts with the wrong amounts posted, like this 10,500 and 105,000, and if you divide their difference with 9, you're going to get a whole number. Let's try. So the difference between these two, 10,500 and 105,000, is 94,500, right? So that 94,500 divided by 9 is 10,500. No decimals. So you are welcome to try the other examples mentioned. Sir, but what if the quotient after dividing it with 9 resulted to a quotient with decimals? Then you have no choice but to go to your entries in the journal and ledger individually. And remember, even if you balance the debits and credits for the unadjusted, adjustments, and the adjusted trial balance, it does not necessarily mean that you got the correct answer. And that's it for worksheet. So now, let's go to the preparation of the first financial statement. The first financial statement is the income statement, but today it is known as the Statement of Comprehensive Income. What's the use of this? Actually, this helps the readers of FS to know if the company is performing well, because the income statement is where the profits and losses are detailed and computed. So I have here a portion of worksheet which only includes the account titles and the last 4 columns of the worksheet, because they will act as a guide in the preparation of the financial statements. So as you can see here, we have the red colored funds which pertain to the income statement. So these details, you just have to rearrange that in a document format. So you can start with the heading, which consists of the company's name followed by the title of the financial statement. In this case, we have the Statement of Comprehensive Income and the period covered. After that, extract the details from here. So let's start with the service revenues, which has a balance of 61,000. So you put it right here, and then followed by all of these expenses from the supplies expense up to the miscellaneous expense. Let's copy them, but never forget their balances. So we have here their balances, and then you total the expenses and you will get 78,533.33. You deduct the expenses from the revenues, and then you will have a loss of 17,533.33, because again, the expenses are greater. So that's it for the income statement. The second FS is coming right next. The second FS is the statement of changes in owner's equity. So this FS just summarizes all the things that affect the equity or capital account. As I've told you over and over in the past videos, the 4 transactions that affect the capital or equity account are: number 1, the investments of the owner; number 2, the withdrawals of the owners; Number 3 is the income or revenues of the entity, and the last are expenses of the business. Now, let's make the statement of changes in equity. But first, we need to have the income statement earlier because it will be used in making the statement of changes in equity. So here it is. So in making the statement of changes in equity, you need to start in the heading, which is the same with the income statement. It is composed of the company's name, the name of the financial statement or title of the financial statement, and the period covered. Next is we get the capital beginning balance, or in simple terms, the equity balance of the entity in the last period. And since our sample illustration talks about a newly formed entity, then our capital beginning is 0. So you can add two things. One is the investments from the owner, in which we have 100,000 according to our illustration, and the second one that we can add is the net income. Unfortunately, we don't have that because the entity according to here suffered a loss. So let's get the total and we will have 100,000. So there are also two items that you can deduct, which are the withdrawals as well as the net loss. So according to our problem, we have withdrawals of 25,000, so we put it right here, and we have the losses of 17,533.33. You deduct these two from this 100,000 and we're gonna get the Gletz capital ending of 57,466.67, which is already the summary of investments and the withdrawals by the owner and the income and expenses of the business. So that's it for the statement of changes in equity. But before we go to the next, please remember this ending balance because it will be used on the third type of FS. The third FS is the balance sheet, but today it is known as the statement of financial position. So we have here again a portion of the worksheet, but now let's focus on the green colored fonts because these are the ones that we need to extract in order to make a balance sheet. So in making that type of FS, we need to make a heading which is also composed of the company name, the title of the FS, and the period ended. After that, let's start extracting information from here. So let's start with assets. However, we will start with the current assets first, or those assets that can be converted into cash or used by the entity in less than a year in simple terms. So by the way, for your information, I have already discussed the current and non-current classification as well as the contra and adjunct accounts in the episode 3 of this series, so you might want to check it out. Anyways, in here, we have the cash, we have the accounts receivable, supplies, and prepaid rent. So let's copy that as well as their balances. And after that, let's add this and we will have the 105,450 as the total current assets. Next is we have the non-current assets. In here, we only have the office equipment with a historical cost of 30,000. But since there is an accumulated depreciation balance of 983.33, then we need to deduct that one in order to get the book value of 29,016 pesos 0.67. So we have to add this 105,450 and 29,016.67 in order to get the total assets of 134,466.67. After that, we have the liabilities and equity. Now we will start with the liabilities, and we will start with the current liabilities, or in simple terms, the short-term liabilities. So we have here the accounts payable, the unearned service revenues, and the salaries payable in the amount of 10,000, 64,000, and 3,000. We have to copy those and we need to get their sum. Their sum is 77,000. Unfortunately though, in our illustrative problem, we don't have any mention of any non-current liabilities, so we put on the non-current liabilities 0. So that means our total liabilities is 77,000 also. And lastly, we have the equity. The equity that we are going to put here is not from here, but instead, it's the equity balance end in the statement of changes in equity as discussed earlier. And if you can remember, that's 57,466.67. Now, we are going to add this total liabilities with the capital ending and we will get 134,466.67 also. The same with the balance on the assets because again, A should always be equal to L plus C. So that's it. But before we go to the next FS, I would like to tell you that there are two formats in the statement of financial position. What we used here is what do we call as report format, where we just listed assets followed by the liabilities and followed by the equity in a vertical format. We have another format where the assets are listed on the left while the liabilities and equity are placed on the right side. And that's it for the balance sheet. We have the statement of cash flows, which explains how the cash ending balance is produced. Logically, the answer is easy. The cash ending is produced by cash beginning or cash from previous year plus cash inflows minus cash outflows during the year. And for that, you can go to the ledger or T account of cash directly. So I have an example right here which was extracted from a past video in this lecture series. So here on the debits are the cash inflows, right? And here on the credit are the cash outflows. However, to make a cash flow statement, you need to further classify the inflows or outflows into three. These three are cash inflows or outflows from operating activities. We have investing activities, and the last is cash inflows or outflows from financing activities. Cash flows from operating activities are those cash flows and outflows related to the normal course of business of the entity. Examples are inflows from customers or outflows to suppliers or outflows due to payment of salaries of the employees. While cash flows from investing activities are those that are related to buying of long-term assets, machinery, or land or equipment, or when the entity invests to earn but such investment is not in any way related to the ordinary course of business, like for example buying of shares of stock of other companies to earn dividends, even though the company is not normally engaged in the buy and sell of shares, or letting others borrow money even if the entity is not engaged in financing in order to earn interest. There is a twist though. What is it? When the investment starts paying off, of course, the entity will receive interest and dividends. Those receipts will be generally classified as inflows from operating activities despite being a result of investing activities. So that's the twist, and you need to remember that. Now let's go to this. So inflows and outflows from financing activities are cash inflows and outflows from getting funds to start or expand the business. Examples are investments and withdrawals by the owner, or getting or paying a long-term loan for expansion. So if the entity is a corporation, proceeds from selling the shares are considered inflows from financing activities because they are considered as investments from owners. However, there is also a twist. When you get financing, eventually you will pay interest and dividends to the providers of funds. So there is no problem with dividends paid because they are considered outflows under financing activities as they should be. The problem is on the interest payments because they are considered outflows from operating activities despite being directly related to financing activities. And that's another thing that you need to remember. So before you forget, I will summarize the twists. Number 1 is dividends and interest received by the entity are inflows from operating activities despite being a result of investing activities. And number 2, the interest paid despite of being a result of financing activities is considered an outflow from operating activities. Now, let's apply what we have learned on this particular T account. What do you mean, sir? Let's try this one. It is said that this inflow is a result of investment from the owner, so this is clearly related to financing activities. So how about this? Payment for business permits and licenses is clearly an outflow from operating activities, as well as this payment of rent and the down payment for supplies, right? So let's put it right here. However, this payment of 30,000 for the purchase of office equipment, since this is an outflow for acquiring a long-term asset, then it is considered an outflow from investing activities, right? So the payment for salaries and the utilities, as well as the payments of customers or receipts from customers, are related to operating activities, right? So lastly, we have this 25,000, which is a withdrawal from the owner. This is an outflow related to financing activities. Now let us prepare a cash flow statement from this. So we should have the heading, and then we should have to start from the cash flow from operating activities, specifically the inflows. According to this, we only have two inflows related to operating activities, and these are the payments from customers, which are 80,000 and 40,000. Let's add these two and we will get 120,000. And then as to outflows, we have payments for business permits, payment for rent, payment for supplies, payment for salaries, and payment for utilities. Now we need to total them and we will get 77,050. We need to deduct the 77,050 from the 120,000. Then we're going to get a net inflow of 42,950 from the operating activities. Cash flows from investing activities and financing activities are actually following the same pattern, as this will start with the inflows. But since we don't have any inflows in the investing activities, so we put here 0. However, we have one outflow related to the purchase of the office equipment, which we have an outflow of 30,000. So we need to add these two and we will get negative 30,000 in the investing activities. In the financing activities, we have one cash inflow pertaining to the investment of the owner worth 100,000 and an outflow of 25,000 from the withdrawal of the owner. So we have a net cash inflow from financing activities of 75,000. So if you total this, 42,950 plus negative 30,000 plus 75,000, you will get the cash ending balance of 87,950. Actually, aside from these three, the cash balance beginning or cash from previous years should be considered also. However, in our illustrative problem, the business that we have is just starting, so the cash beginning, which is 0, is ignored. So that's how you make the cash flow statement. But let me emphasize that what I taught you is just the basics of cash flow statement. In my next videos, I will teach you how to make a cash flow statement using direct and indirect methods. And that's it for this particular slide. But we are not yet finished. We still have one thing to talk about, and that's up next. The last thing that I'm going to emphasize is the notes and disclosures. Actually, if you're going to make a set of financial statements, we can have the page 1 for the income statement. The next page could be the statement of changes of equity, followed by the balance sheet, and followed by the cash flow statement. But the last should be the disclosures, which is composed of a lot of pages. Why? Because this includes a lot of things, like for example, information about the entity, like who are the owners of the business, or the principal location of the business, or the registration numbers of the business issued by many government regulatory bodies, and the details about their permits and licenses. It can also include a brief history of the business. Why? Because actually guys, these details of information are very important to know if the business or the entity is legit and existing. So it also contains the different accounting policies used by the business. For example, what is the depreciation method adopted by the company? Is it the straight line method or other methods? Because there are a lot of methods on estimating and computing depreciation. You will know more about these methods and the different accounting policies on my next videos. The notes and disclosures also includes the most important information, which is the breakdown of the account balances used in the 4 financial statements mentioned and discussed earlier. So we have an example right here. The accounts receivable of the entity is composed of receivables from A and B for 2,000 and 2,500. Other receivables are 500. So all in all, the entity has a receivables of 5,000. So you can also do this breakdown with cash, like for example, cash in bank per bank account, or you can do this also to payables to different suppliers. And lastly, there are other disclosures required, which will be detailed on my next videos, so stay tuned. And that's it for this video lecture. Please click like, subscribe, and share this video. If you have questions, you can comment it in the comment section. Thank you for watching.